They told you a number in 2008, a cold, polished number delivered with confidence, broadcast on every screen in America, $700 billion. It sounded enormous, heavy enough to symbolize national sacrifice. It was repeated in hearings, printed in newspapers, spoken by presidents and economists as if it were a natural law of the universe. But it wasn't the truth, not even close. Because while the public argued about that $700 billion while Congress performed its televised debate over moral hazard and systemic collapse, another operation was happening in the shadows, quiet, invisible, and exponentially larger. Behind closed doors, the Federal Reserve was not lending billions. It was lending trillions. They kept that secret for 3 years. In 2008, when Lehman Brothers fell, when that 158-year-old institution collapsed under the weight of its own greed, panic spread like a shockwave through every corridor of global finance. Markets convulsed, credit froze. For a brief moment it felt like the entire economic engine of the world was stalling mid-flight. And the government stepped out to reassure the public with a controlled, practiced performance. We have a plan. We know what needs to be done. TARP, the Troubled Asset Relief Program, a name engineered to sound responsible and solemn. $700 billion allocated to stabilize the system, rescue the financial architecture, and protect the American economy. At least that's what the script said. But while cameras captured every second of that public debate, another reality was unfolding in absolute secrecy. The Federal Reserve had begun opening emergency lending programs that went far beyond anything Congress approved. These were not small injections of liquidity. They were fire hoses running at full pressure, blasting trillions of dollars into the vaults of the world's most powerful banks, all hidden behind layers of technical terminology, facilities with long bureaucratic names designed to distract rather than inform. Programs built not to be understood, but to be ignored. Through them, the Fed created money out of thin air and funneled it to institutions on Wall Street, to corporations, to hedge funds, and even to foreign banks across Europe. And the public? The public got nothing but silence. Not even Congress knew the scale. Not even shareholders knew their banks were on clandestine life support. Not even regulators outside the Fed were shown the full picture. It was a parallel financial universe that operated in the dark for 3 years. The truth only surfaced because a single newsroom refused to accept the silence. On November 7, 2008, while the crisis still burned, Bloomberg News filed a lawsuit against the Federal Reserve demanding basic transparency. Who received the money? How much? What collateral did they offer? The Fed refused, claiming disclosure would harm the banks and incite panic. But the courts didn't buy it. And in 2011, the Fed lost its final appeal and was forced to release the data. What emerged was beyond shocking. The total secret lending wasn't $700 billion. It wasn't even $1 trillion. It was $16.1 trillion. $16 trillion created and distributed without a vote, without a press conference, without a single moment of democratic oversight. A sum larger than the GDP of the United States at the time, loaned out quietly, invisibly, as if it were a minor footnote rather than the largest transfer of wealth in modern human history. And when researchers dug deeper, another revelation surfaced. At the peak of the crisis, the Fed had over $7.7 trillion in loans outstanding simultaneously. More than half of the U.S. economy at that time, out the door, in secret. The list of beneficiaries looked like a directory of global finance. Citigroup, $2.5 trillion, Morgan Stanley, $2 trillion, Merrill Lynch, $1.9 trillion, Bank of America, $1.3 trillion, Barclays, UK, $868 billion, Bear Stearns, $853 billion, Goldman Sachs, $814 billion, Royal Bank of Scotland, $541 billion to Deutsche Bank, Germany, $354 billion, UBS, Switzerland, $287 billion. These numbers weren't internet rumors or fringe speculation. They came from official documents released by court order and validated by the Government Accountability Office. But the most infuriating part wasn't the scale. It was the silence, the calculated secrecy, the deliberate decision to conceal a global rescue mission financed by American taxpayers while millions of Americans lost everything. By the time the truth came out in 2011, the damage was irreversible. The banks had recovered. Executives had been rewarded. Shareholders had pocketed gains built on almost free money. And the public? The public was busy rebuilding their lives from the rubble of foreclosures, unemployment, and lost retirement accounts. The lie worked. Because the lie was never about the $700 billion, the lie was about hiding the trillions behind it, trillions that would have provoked outrage, disbelief, and perhaps political revolt if revealed in real time. And the most dangerous part? The system that enabled it, this hidden machinery of emergency lending, this quiet architecture of secret bailouts, still exists, untouched, waiting. The world learned nothing, or perhaps learned the wrong lesson, that crises can be concealed, manipulated, managed behind soundproof walls while the public is fed a simplified narrative designed for calm consumption. That's why this story matters now, not as history, but as warning. Because what happened in 2008 didn't just save the financial elite, it rewired the entire economic system. And the next chapter of this story is already writing itself. When the secret lending data finally became public, analysts discovered something even more disturbing than the $16 trillion itself. A massive portion of the rescue money didn't even stay in the United States. The Federal Reserve, the central bank of the United States, had quietly transformed into the world's emergency banker, funneling hundreds of billions into foreign institutions that most Americans had never heard of, and certainly never agreed to save. Deutsche Bank, UBS, Barclays, RBS, BNP Paribas, names that were familiar to economists, but irrelevant to the average American family losing their home or job during the crisis. Yet these foreign institutions received lifelines larger than the budgets of entire U.S. states. And the justification was almost surreal. They needed dollars. Dollars created by the Fed, backed by American taxpayers, to save institutions operating thousands of miles away. Why? Because these banks were entangled in the same toxic web of dollar-denominated assets, mortgage-backed securities, and derivatives that Wall Street had engineered and sold across the world. When the American housing market imploded, European banks found themselves drowning in U.S. financial products they barely understood, but were desperate to offload or finance, and the Fed obliged. Not because voters approved, not because Congress legislated it, but because the global financial system had become so interconnected, so fragile, so dependent on the U.S. dollar, that saving Wall Street required saving its foreign counterparts as well. The Fed didn't announce this. They didn't warn the public. They simply opened the taps. And while the United States was hemorrhaging jobs, while towns were collapsing under foreclosure waves, while small businesses were dying, international banks were receiving secret loans large enough to buy entire American industries outright. Deutsche Bank alone received $354 billion. The same bank later fined billions for money laundering, LIBOR manipulation, and fraudulent activities stretching over a decade. Barclays, $868 billion, a British giant infamous for its role in interest rate rigging. UBS and Credit Suisse, nearly $450 billion combined.
Swiss behemoths involved in tax evasion scandals and risky trading losses. None of them repaid the damage they helped cause, but all of them benefited from the U.S. rescue they never contributed to. And you were never told. While foreign banks received secret loans at near zero interest, American families were trapped in a nightmare far more brutal.
The forgotten victims, homeowners between 2007 and 2010. 3.8 million American families lost their homes to foreclosure. Entire neighborhoods were gutted. Streets that once echoed with laughter, barbecues, and birthday parties became rows of empty houses with overgrown lawns and foreclosure notices peeling in the sun. These were not speculators or gamblers. They were teachers, mechanics, nurses, veterans, people who trusted the financial system, people who believed the American dream still meant something. But when the system crashed, they were abandoned. The government's answer for homeowners was HAMP, the Home Affordable Modification Program, a program advertised as a lifeline, promising to modify mortgages and halt foreclosures. But it was a facade. Most homeowners waited months for responses. Many were told to miss payments to qualify, only to be denied later for missing those same payments. Banks lost paperwork, demanded documents repeatedly, or simply ignored applications. Of the $75 billion allocated, barely a third was used. Of the millions of families seeking help, only 1.3 million received permanent modifications, and many of those modifications still ended in foreclosure. While the Fed lent trillions to banks at 0.5% interest, homeowners were drowning at 6 to 7% mortgage rates. The imbalance wasn't an accident. It was a design. Banks were rescued. People were sacrificed. The illusion of collateral. The Federal Reserve insisted the secret loans were safe because they were backed by collateral. But that collateral was often the same toxic mortgage-backed securities that had triggered the crisis. Assets that had plummeted in value, some worth pennies on the dollar in real markets. Yet the Fed accepted them at face value. Imagine owning a house worth $300,000 before the crash, but now worth barely $150,000. Imagine if a bank looked at your underwater home and offered you a $300,000 loan anyway. No bank would do that. But the Fed did, billions of dollars at a time. The central bank did not mark these assets to market. They did not question the valuations. They simply took whatever numbers the banks provided, even if the assets were practically radioactive. This wasn't lending. It was a covert asset laundering operation. Garbage assets went into the Fed. Fresh cash came out to the banks. The public absorbed the risk, and the banks kept the upside. And when investigators later asked what happened to that collateral, the Fed refused to answer. To this day, we still don't know how much was lost. The central bank simply buried the data behind confidential supervisory information. The public paid the bill, but the public never got the receipt. The era of zero accountability. The crisis exposed one of the most disturbing truths about modern finance. In the United States, no major Wall Street executive went to jail. Not one. Despite fraudulent mortgages, illegal foreclosures, rigged ratings, toxic securities knowingly sold to pension funds, manipulation of global interest rates, laundering of cartel and sanctioned money, insider bets against their own clients. The FBI had thousands of agents working on mortgage fraud in 2007, until 2008, when most were reassigned to counterterrorism, leaving white-collar crime investigations to wither.
The Department of Justice chose settlements over trials, civil fines over criminal charges, press releases over accountability. Attorney General Eric Holder even said it openly. Some banks are too big to prosecute. Not too innocent, too big. And so banks paid fines, fines that shareholders absorbed, not executives. Goldman Sachs paid $5 billion in settlements, but that same year made more than $40 billion in revenue. For them, it was not punishment. It was a fee, a line item, a mild inconvenience. Meanwhile, the executives at the center of the crisis continued earning tens of millions in compensation. Jamie Dimon of JPMorgan, $20 million during the collapse. Lloyd Blankfein of Goldman Sachs, $54 million the year before. Merrill Lynch paid $3.6 billion in bonuses the very year it collapsed and was absorbed by Bank of America. These were not leaders facing consequences. They were winners collecting rewards. And the American public was told to move on.
The perfect crime. When the dust settled, the picture was clear. Wall Street was rescued in secret. Foreign banks were rescued without consent. Homeowners were left to drown. Executives were rewarded. No one was punished. And the system that enabled it became even more powerful. The bailout we were told about, TARP, was merely the stage prop, the performance, the distraction. The real bailout happened off-stage, in silence, in the dead, mechanical heart of the Federal Reserve, using powers almost no citizen understood. It wasn't 700 billion. It was 16 trillion. And the world learned the wrong lesson, that risk is irrelevant, consequences are optional, and the public will always pay, quietly, unknowingly, and too late to fight back. The most dangerous part is that everything done in secret from 2007 to 2010 can be done again, and the system is now larger, more fragile, and more interconnected than it was before. The next part of this story reveals just how close we came to systemic collapse, and why the next crisis might force the government to take something far more personal than your tax dollars, your deposits. The deeper investigators dug into the 2008 crisis, the more they discovered a truth too unsettling for the public to accept. The financial system wasn't saved. It was simply rewired to fail in a new way. The bailout didn't repair the structure, it reinforced the rot. And in the shadows, it laid the foundation for an even more dangerous future. Because while the public narrative ended in 2011, the real story kept going. It still hasn't stopped. The banks that should have died but didn't. In a functioning capitalist system, the institutions that caused the collapse should have been dismantled. Their shareholders should have lost everything. Their executives should have been fired or prosecuted. Their toxic assets should have been unwound. Their power should have been broken. But that didn't happen. Instead, the opposite occurred. The largest banks emerged from the crisis stronger, richer, and more powerful than ever. The weak institutions were absorbed. The survivors, JPMorgan Chase, Bank of America, Wells Fargo, Citigroup, Goldman Sachs, became megabanks, holding unprecedented control over deposits, credit, and global markets. Before the crisis, the top 5 U.S. banks held 40% of all banking assets. After the crisis, 47%. Today, they're even bigger. These institutions learned that size isn't a liability, it's leverage. Become big enough, and the government has no choice but to save you. Become essential enough, and the Federal Reserve will flood the world with money to keep you alive. Become complex enough, and no prosecutor will dare touch you. This wasn't a failure of regulation. It was the unveiling of a disturbing new economic philosophy. Too big to fail is the same as too big to prosecute, and too big to prosecute becomes too big to obey. That's the world created after 2008. The return of moral hazard. When you remove consequences, you remove restraint. And when you remove restraint, you invite catastrophe. Wall Street learned 3 lessons from the secret bailout. Risk doesn't matter. If bets go wrong, the Fed will intervene. Fraud doesn't matter. The worst outcome is a fine paid with shareholder money. Failure doesn't matter. Collapse simply triggers another rescue. This is moral hazard at a planetary scale. After 2008, banks increased leverage again. They expanded derivatives trading. They pushed deeper into exotic financial engineering. They lobbied to weaken regulations. They bought back billions in stock, enriching executives while hollowing out balance sheets. The world was told Dodd-Frank would prevent another crisis. But buried inside its thousands of pages was a mechanism more dangerous than the last bailout, the bail-in. In the next collapse, instead of using taxpayer money to rescue banks, the system will allow banks to rescue themselves using your deposits. The money in your account is no longer your money in a crisis. Legally, you become an unsecured creditor. Your deposits can be seized, converted into bank stock, and used to recapitalize the failing institution. This isn't speculation. It already happened. The Cyprus warning. In 2013, the small nation of Cyprus became the test case for modern financial triage. The country's banking sector imploded after years of reckless lending. Depositors woke up to find accounts over $100,000 frozen balances forcibly converted into equity. Nearly half of their savings gone overnight. Perfectly legal. Perfectly devastating. This was called a bail-in, a polite term for confiscation. The U.S. took notes. Dodd-Frank quietly adopted similar provisions, granting regulators the authority to seize deposits during systemic crises. Most people have no idea. Banks don't advertise it. Politicians don't mention it. But the mechanism exists. And in a world where the next crisis could be larger than the last, the bail-in isn't a backup plan. It's the plan. Why the next collapse will be bigger. The conditions that led to 2008 didn't disappear. They mutated. Today, debt levels are higher than in 2008. Government, corporate, personal. Interest rates are volatile, whipsawing markets. Derivatives exposure is larger, more complex, and more globally interconnected. Banks hold more power, not less. Shadow banking systems, private equity, hedge funds, and non-bank lenders operate with even less oversight. Asset bubbles span everything from real estate to tech valuations to corporate debt. The economy is a towering structure built on a thin foundation of assumptions. The assumption that the Fed will always step in. The assumption that money can always be printed. The assumption that the system will hold. But a system built on assumptions is not stable. It's fragile. And fragility always breaks when it's least expected. The secret they don't want you to see. The greatest lie of 2008 wasn't the $700 billion number. It wasn't the secrecy. It wasn't even the $16 trillion bailout. The greatest lie was the message repeated endlessly afterward. The system is stronger now. That's what they wanted you to believe. That regulation fixed the problem. That oversight was improved. That the banks learned their lesson. That the economy is stable. But the reality is this. The same institutions that collapsed the world economy are bigger than ever. The same executives remain in charge, enriched by bonuses funded indirectly through crisis rescue money. The same mechanisms used to hide trillions in loans remain legal. The same moral hazard has evolved into a permanent operating principle. The public still has no visibility into emergency Fed operations until years later, when the damage is irreversible. And worst of all, the system now has a built-in escape hatch that didn't exist in 2008. Your deposits, your savings, your checking account, your retirement balances. In the next systemic failure, these funds can become legal collateral, not by conspiracy, but by design. The story isn't over. The 2008 crisis did not end. It simply went quiet. It became a hum in the background of the global economy, a vibration felt but rarely acknowledged. Because the truth is uncomfortable, the crisis created a playbook. The playbook was never closed, and every major central bank in the world has read it. When the next financial storm comes, and it will, they won't start with $700 billion. They won't ask Congress. They won't appear on television explaining the plan. They will go straight to the hidden machinery, the secret facilities, the digital printing presses, the emergency powers that let them move trillions with no oversight. And by the time the public learns what happened, it will be history repeating itself, just like before. The final image. In 2008, the world didn't just witness a bailout. It witnessed a transformation, a turning point where the financial elite discovered that with enough influence, enough complexity, and enough opacity, they could bend the global economy without permission. They did it once. They can do it again. And unless people understand the truth, not the televised truth, but the hidden truth, the next crisis will feel less like a mistake and more like a plan.